I haven't had a chance to really read what's going on with the banking. It does look, some of the stuff John Tui sent me, but it looks like they messed up on the basic stuff we did in this class, which is just really outrageous high duration net worth. I got the impression from Silicon that they saw a steep yield curve and they decided to roll the dice and go out. And yeah, you invest at 2% when you're paying 0.1% on your. It sounds pretty good, right? A 200 basis point spread sounds pretty good. But why is the yield curve so steep? Well, so steep because they're expecting rates to rise. So I don't know what the duration net worth is. Just to remind you, you'll see this on the CFA exam. So if you got a 5-year bond, well, let's do 10 years. You got a 10-year bond. So you can take the present value of that. That gives you the price of the bond of 1125.65. So you got a 5% coupon. So you're getting $25 twice a year, every 6 months. You discount that. So let's say the bond coupon is 5%. The discount rate's 3.5%. So what is the duration? So just to remind you of duration, it's a pretty simple concept. I mean, there's some formulas. If you showed your friends, they'd be really impressed, but you look at it and it's a pretty simple formula. That's the sum of the present value of all the cash flows. That's a pretty simple formula, isn't it? And so is the numerator, except for one thing. What's in the numerator is not in the denominator. Time, right? So what is duration? It's just a weighted average time to maturity. All duration is telling you is, hey, we get our cash flow in 10 years, but we get some cash flows before that. So the real duration of this is we get the present value, so that you're weighting your time, but by the present value. So that times the time. Take that, divide it by the price. That's exactly what that formula is doing. So there's nothing complicated about duration. The nice thing, especially on the CFA exam, because sometimes I remember on the CFA exam, I would get confused. Say interest rates rise, what does that do to duration? It's pretty simple if you got the formula. So yeah, all duration this is Macaulay duration, and I can never spell Macaulay. M-A-C, yeah, it's got too many A's in it. M-A-C-A-U-L. So the Macaulay duration, you just sum those up and say, yeah, most of our cash flow comes in 10 years, but we get so many cash flows before that our duration is only 8.13 years. So where does positive convexity come from? Well, what happens to duration when rates rise? And you can do it off the top of your head, can't you? Let's think about this formula. What's going to be most sensitive to rates rising in this whole list? It's going to be that very last cash flow, isn't it? And what is it going to do when rates rise? It's going to fall the most. So if the thing that has the biggest weight in duration falls the most when rates rise, what's duration likely to do? Rates rise. It's going to fall. That's wonderful, isn't it? As rates rise, duration falls. So as you're losing money, you're losing less because duration is coming down. It's a wonderful, wonderful thing. So rising rates reduce duration. What do falling rates do? The exact opposite. So duration jumps from 813 to 825. And they asked us on the exam, I think it's a pretty basic question that you can figure out. Yeah, I don't know why it's doing that. So rising rates reduce duration, except for what? So Silicon Valley Bank, so they decided to go out on the yield curve and they bought mortgage securities. What do we know about mortgage securities? What does duration do for mortgage securities? When rates fall, what does it do? So when rates fall, you want duration increase, right? So you have more exposure to rates falling. So that's great. What do mortgages do? They prepay. What do durations of mortgages do when rates fall? Durations shortened, exact opposite of what you want. What happened to duration mortgages when rates rise? They lengthen. Why? Because people pay down their mortgage more slowly. If they've been paying an extra $200 a month, rates rise, they won't pay the extra 200. So you have extension risk. That's what we call negative duration. Negative convexity. So my sense of reading the articles on Silicon Valley is that they bet on these steepening yield curve. They let the duration net worth get ridiculously high, and they went more negative convexity, which exacerbated the problem. But how did they get away with it for so long? And so I think I mentioned in an earlier class, there's some FASBs you should probably know that I don't think they're teaching you. So I don't know how to. Didn't we talk about that earlier? Maybe not in this class, I can't remember, but you'll now know these things, right? I told you this was important stuff, and now you're seeing the part. So what is HTM? Held to maturity bonds. What's AFS? Available for sale. You have permanent impairment. You have the 3 levels. Have y'all seen this in any of your accounting classes? They even mention it? And why don't they? Because it's mainly for banks and insurance companies. And undergraduate accounting, banks and insurance companies don't exist. They're not even entities because the accounting is far too complicated. But I was talking to one of our students. He's been researching this. I remember when this stuff came out, boy, at UTSA, this was a huge deal. We spent a lot of time. The one question we had on held maturity, we had this big debate. A bond manager would say, well, it's a corporate bond. Obviously, if they get downgraded, we can sell the bond. And they said, no, once you sell one bond in HTM, the entire thing becomes available for sale. You can't say, well, we thought this was HTM, but this one, you can't. You tank the entire portfolio. So in one split second, you have a bond portfolio that's suddenly got to reprice the entire thing. So then you're asking, well, do we want to put it in held to maturity if we can never sell this bond, even for credit reasons? And that's what they said. Yeah, if you think you're going to sell this bond, it can't go in there. Those were huge debates. The other question was permanent impairment. So what the accountants say, we had a big debate with the auditors. It was fun. If a bond becomes permanently impaired, even if it's held to maturity, well, how are these valued? Yeah, I remember from the articles, since you didn't have in your accounting class. Any guesses? Starts with an A. So amortized cost, you remember that? Divided the premium, you can use the interest method, and you're going to dissipate that premium over the life of the bond down to par. Does that sound familiar? Y'all do that in your accounting class. So amortized cost, but there is an exception. What's the exception? Permanent impairment. If a bond's permanently impaired, you have to write it down to market value, even if it's in held to maturity. What does permanent impairment mean? Well, that was the big debate. We didn't know because it wasn't defined. So a bond that's not likely to get back to par value, but in what time framework? So what's interesting right now, we normally thought of this as a credit issue. So a bond's price is falling because they have a credit issue, and so you write it down. That doesn't taint your entire held to maturity portfolio, but you do have to write that one bond down. I don't know what auditors are doing now when bonds are underwater because rates are high. Because if you have a bond that's trading for 900 because rates are high, it's still going to mature at 1,000. You're still going to get your money back, but that might be 8 years from now. You have to write it down, and that's what everybody's going through with this. Do y'all know the rules on permanent impairment? Let's say you have a credit issue, the bond looks like it's in a lot of trouble, so you write it down. Let's see, 35%. And then you find out 2 months later, everything's fine and you get rescued. What do you do then? Can you write it back up? No, you can't. Guess what just happened? This becomes your new amortized costs. you can't write bonds up, you can't write them down. So once you permanently impair it, it's impaired until it matures. You'll never get. So that's a pretty big decision, right? Is it permanently impaired? So in 2008, this was a huge, huge issue. When bonds are falling 80%, there's a good chance it's permanently impaired. Even though they shot back up 80%. Can you imagine in 2008, bonds are dropping 50, 60, 70%, and they shot right back up the next year back to par. We were having this discussion about permanently writing them down, and then sure enough, the next year they're back up to where they were. It's really, really rough year. Available for sale bonds are just at market value. Our fair value, that's where the three levels come in. So, you know, if I were you, I'd be reading these. I can't remember what FASBs they are. Asset valuation levels. Level 1. FASB, let's see if we can find it. Y'all see the FASB, let me know. But you can find all kinds of articles about it. I don't see it obviously jumping out. There's the IFRS. IFRS 13, but where's the FASB? So this also comes into play because some bonds have ready market values like stocks. Some bonds don't trade all that much, but they have pretty reliable model valuations. Some bonds, some assets aren't traded much at all, and they get pretty tough. So yeah, that's the other. All these are coming into play, and all of this information is in the financial statements for Silicon Valley. But how do you interpret it? You go into the footnotes and get all that detail. So William, one of our students, he actually took a bunch of banks and he took their held to maturity bonds and he took the unrealized losses and subtracted from the bank's net worth. And he found some banks that lost their entire net worth, the unrealized losses on their available, and then they're held to maturity. You don't have to do the available sale, they're already there. So he's saying, are these bonds insolvent? Well, what else do they have? Well, what about a 5-year CD? So you got a 5-year bond, rates rise, you have to write it down. What did that 5-year CD do? Let's say you sold a 5-year CD last year at 2%, and now rates are 5%. That CD went down in value as well. That's a liability. So what I told William was, hey, yeah, the assets are down, but you're not repricing the liabilities. They may be down as well. Maybe the bank actually did a good job of matching them. Maybe they bought a 5-year corporate bond or 5-year bond paying 4% and now they're paying 3% on the CD. 5-year CD got 1% locked in. That could be perfectly fine, but the only thing you're seeing reprice is the bond. So I don't think he has enough information to say, yeah, that bond's insolvent. It's just not available. Even Silicon Valley, these are complicated entities. I haven't looked at seen anything in Republic. Although Republic Bank was one of those banks that had a huge loss when they held to maturity. Why do you have huge losses? Because they bought longer term bonds and rates are up. So that's the big issue this year versus 2008. 2008, it was credit. 2023, it's rates. So, and I have no, I mean, I've been away from this for so long. I don't know what the auditors are saying, what debates they're having. I mean, William is saying, well, it's pretty subjective. So management has decisions. Like, yeah, but the auditors have to sign off on it. So if you don't convince the auditors, you can say whatever you want to, but they've got to decide. So I was there right when all this was hitting, and boy, the debates we had some pretty intense discussions. And so how do you handle things like this? You have to run scenarios. What if spreads do this? What if rates do this? And you got to go through those scenarios. So what would we do in this situation? Oh, we definitely would sell that bond. Well, you better put it in available for sale if that's the situation. Because the last thing you want to do is you say, well, we'll probably hold these maturity 90% of the time. But that 10% is during a crisis that if you have to sell them the bonds, you now have to write off like $500 million and your net worth is $300 million. That's not this. You don't want a situation where when you have to do it, it's the worst possible time to do it. But that's usually the case, isn't it? And so you kind of have to watch that. But then if you have an available sale, it's going to go through your market value anyways. So our life insurance company, their big issue was all this accounting was forcing us to write our assets to market, but our liabilities were well matched. That accounting doesn't mark our liabilities to market. It's making us look a lot worse than we are. And so they're convinced that the accounting is really bad. Banks, I think it's just a mismatch. I mean, it's true, the bank could have a 6-year auto loan. That's going to come down in value, but the bank's probably going to securitize that and sell it off anyway. So they probably won't have in their books. So it's really going to come down to the liabilities and what those are. The other discussion we had was checking accounts and savings accounts. And that's a tough one. Those are called core deposits. Banks really don't know how to model those. And what is your savings account paying right now? I'm hearing some banks are raising their rates. Is your savings account paying 3%, 4%, or is it still close to zero? I think I make like 13 cents a month on my savings account. I always look forward to it. In a year's time, I think I find more money riding my bike in change than I get from that savings account. But yeah, these are core deposits. At USAA, we ran our duration of net worth with and without core deposits. We got radically different answers. It's like, so what do we do? Are we exposed to rates rising or falling? Well, we don't know. Depends entirely on how you assess core deposits. So these are tough situations. And then you're analyzing these banks and trying to make a decision. Is this bank in trouble, or is it the accounting just messing up the numbers and causing things to look a lot worse than they really are? That was the issue in 2008 as well, with banks having to write all these assets down to fair market value. And there was a lot of calls to the SEC and the FASB and saying, hey, could we get away from this fair value accounting? It's really causing havoc. Was it causing havoc, or are the banks really in trouble? That's kind of thing. It's like, we're really okay, but we're having to do this write down, or we're really in bad shape, but you still don't want to tell anybody about it. You know, that can be the issue as well. Yeah, it's interesting times. What else are y'all seeing in the news on these kind of things? If you'd worked for Silicon Valley last year, would you have been, I mean, after this class, would you have been like raising the red flag? Y'all realize how exposed? They should have been running some simulations, shouldn't they? Someone should have said, hey, what if the 10-year hits 4.5%? Wouldn't that have been a pretty viable question to have asked? I mean, when you have a steep yield curve, the bond market's telling you rates are going to rise. So that seems like that would be a pretty logical scenario to run. Yeah, it was crazy. Let me tell you how crazy it got in 2008. Corporate debt. There's firms say, hey, we're borrowing money and we're in a lot of trouble. We're getting downgraded. We want to mark our debt to market. We borrowed $2 billion, but it's not worth $2 billion now because we got downgraded. So we want to write our debt down to 200 million. Does that make any sense? They borrowed 2 billion, but the market value of that 2 billion is 200 million. Hey, we just made $1.8 billion because the market doesn't think we're going to pay our debt back. That's the kind of discussion you're having in 2008. So if you want to mark our assets to liability, I mean, to market, we'll mark our liabilities to market, and our liabilities aren't worth much. Crazy, crazy stuff in 2008, but so different. Because in 2008, treasuries were up a bunch, which is what banks tend to buy. This last year, treasuries were down, 10-year treasury is down 15%. The stock market was down 15%. So last year, banks got really crushed, even on the highest quality. I mean, when you're highest quality, you know, they don't hold capital against the 10-year treasury, right? It's a low risk, risk-free asset. So if it's down 15%, it really can create surprises. We'll see. My sweet spot for tomorrow night, I mean, it's pretty amazing what happened last week. I got to show you all this again. Sorry, Carlos saw it in my earlier class, but I just think it's amazing. Y'all weren't paying attention because y'all were on the beach, but 60-year-old professors don't go to the beach. So I was watching markets, and I don't care about what's going on with politics. And it is I emailed my best friend is a bond manager. Yeah, I was emailing him last week. I gave him my forecast for bonds. He didn't much care for it. So the standard deviation, the 10-year Treasury yield change is what? Some of y'all know, right? Waylon, you know, Carlos. The standard deviation, the 10-year Treasury change. How many basis points? 6.5. That's what happened over spring break. Not that. So last Monday, interest rates fell 18 basis points. That's almost a 3 sigma event. Bonds rallied. What did stocks do that day? Well, stocks fell that day, but not as dramatically. Yeah, we got to see that because we talked about this earlier. This is like a perfect example of what we've been talking about. It is when I see weeks like that, what comes to my mind is there's something going on we should be paying attention to, but the problem is it's really hard to know what's actually happening. So the data market was up. So what's the standard deviation of the S&P 500? 1%. So bonds rallied, stock market was flat. Bonds sold off, stock market rallied. Bonds rallied, stock market sold off. Bonds sold off, stock market rallied. Bonds rallied tremendously, stock market was flat. Bonds have sold off, stocks. What's the correlation? It's positive 0.9, which means the correlation is negative 0.9 because interest rates fall, bonds are up. So remember what we talked about, when bonds and stocks are positively correlated, what's the market thinking about? They're thinking about inflation. Was the market thinking about inflation these last 7 days? No, they're thinking about something else. So who wins? So the bond market, last week, the bond market, it fell 30 basis points, but now it's only down 9 basis points. So this week has been a pretty good sell-off in bonds. Stock market last week was up about 0.5%. So when they fell, they didn't fall that much. When they're up a bunch. So the stock market is back up above 4,000, isn't it? Wow, way above 4,000. It's pretty ridiculous. 4,034. It's not close to its all-time high, obviously, but how far away are we from the all-time high? It's quite a bit. So we're still quite a ways away, 15% or so from the all-time high, but we're above that 4,000 again. So I don't know if that's not the all-time high. It was some time ago. Yeah, so we've essentially been going sideways here for quite some time. But remember, everybody's saying rates are rising. But what did the 10-year Treasury get up to? Something well above 4. $4.33. We're now down to 3.60. So that's 70 basis points. That's a pretty good drop when the Fed is raising rates. So it's pretty amazing stuff. So the bond market especially is telling us something because the bond market is far more volatile than the stock market right now, in terms of relative to its history. You know, we're seeing 2 and 3 sigma events. In the stock market, we're seeing 1.5 sigma events. It's been much more volatile in the bond market. Something that you might ask is who's better, the bond market or the stock market at predicting the future? I remember trying doing studies like that in the past. When the stock market rallies, do we get a strong economy 6 months later? When the bond market does certain things, you know, who's better predicting? And I think it's kind of sometimes one gets it right. The convention is the bond market's really good at predicting disasters and the stock market's really good at predicting the bottom and the way back up. But you'd have to really research that and see if that's true. But anyway, interesting stuff. I'm glad I'm retired because you guys, you're walking into quite a mess that my generation created, but it's not my problem anymore. All right, so let's talk credit risk. Credit risk is the thing, some of y'all talked about it in your paper. Many of y'all are glad you didn't have to talk about it in your paper. Did you notice what a mess credit risk is? It should be the hardest thing banks deal with. So Silicon Valley messed up on the easy stuff. Credit risk is the hard stuff, really, because there's no obvious way to handle this risk other than just being really diligent. So what is credit risk? Risk is you have some contractual relationship with someone and they fail to perform. It's also known as default risk, bankruptcy risk. You can make a distinction between default versus spread risk. So default risk is that they actually don't pay you, they miss a payment. Spread risk is they get riskier and their spreads gap out. So the market's telling you there's something wrong. They may make all their payments, but the market's telling you there's something going on here. You can also think about this in terms of downgrade risk. So you bought a single A bond and now it's downgraded to triple B. It's still paying. It's not, hasn't missed a payment. So that's one question. That we used to do in your paper one. Some banks put default risk under credit risk, and they put spread and downgrade risk under market risk, under price risk. Some banks put them both under credit risk. So it just depends on the bank and their philosophy. They can be very different. In 2008 especially, there were a lot of bonds dropping 30, 40, 50% that the bondholders had very high confidence they were going to pay off on time. And a lot of that, they were right, because in 2009, they came roaring back pretty rapidly. So you can make that distinction. It gets back to the available for sale. If it falls 20%, it doesn't really matter to you think it's good, because you're down 20%. You've got to do something with that information. So the Federal Reserve's issue is figuring out if it's a credit risk or a liquidity risk. If it's liquidity, you provide liquidity, they make it through the rough spot. If it's credit and you provide liquidity, you're just going to make the issue much worse down the road. So the Fed has to figure that out. I don't know what they've decided on Silicon Bank. That looks like a credit risk to me, but they've got to kind of decide that. It's not the easiest thing for the Fed to do. It sounds like they're going all out, aren't they? What's Yellen been saying? U.S. may also protect smaller banks if needed. Vows to safeguard deposits at smaller U.S. banks. What does that mean? Does he mean up to the FDIC? If that's the case, she doesn't need to say that because it was already there. Or she's saying she can protect all deposits. You can protect all deposits of retail depositors. Does this include, Silicon Valley Bank was a lot of corporations. Is she going to protect them? What exactly? I haven't listened to her today. What is she actually saying? Is this just a bunch of words to keep people from running on the bank? She's just hoping if I say a lot of safe sounding things, people won't run to take their deposits out. Bank runs look a lot different today, don't they? Bank runs today are people at their computers at home clicking away. It's not these long lines around the banks, so it's a very different thing. It's hard to see it. I don't know if that means, if you're driving home and you see 50 people in line at your bank, that might cause you to do something that you don't know about if you don't see them at home clicking away.
Like how this bank run is different from 2008, second 2008. Bigger banks have more expensive securities, and I guess that was the main issue, the subprime prices. Whereas now, you get to see that people are taking away money from smaller banks, and that money is being deposited to bigger banks like JP Morgan and CD Bank.
Well, this doesn't feel like 2008 to me. Of course, I went 6 months without sleeping in 08, but then I'm retired too, so maybe it doesn't feel like it because I'm not there every day, but it doesn't feel nearly like that. So in 2008, they increased the FDIC from 100 to 250. That was a pretty significant draw. The government started a new program to backstop money market accounts. So they did some pretty Herculean things. I don't remember them saying we're going to protect every depositor in 2008. That's a pretty radical thing. But then I never thought our government would mail out $1,200 checks to every American either. That's kind of a radical thing too. So we're doing some pretty radical things since 2020. So I'm not really sure if she's saying something different or it's like it's the same we've always done. I'm just going to say it in a way that kind of, if you read between the lines, maybe people think we're protecting you more than we have in the past. I don't really know exactly what she's saying. I mean, she is former feds, and the Fed is, does Fed speak? You can't play all your cards, so maybe who knows what she's saying. Does she have the authority for them to bail out deposits over 250? You would think that's Congress's decision, wouldn't you? Can the Fed chairman or the Treasury Department say, hey, you know what, we're going to protect you up to 500,000? I don't think they would have that kind of control. One thing that irritates me about the FDIC, if you went to their website, I don't know if it's true today, but if you went to their website back in 08, they would tell you how to take that $250,000 protection and make it 2 million. So you name your spouse as a beneficiary on your CD. You name your kids as a beneficiary in your CD, and each one of them get 250. So you name your cat and dog. I don't know where they put the limit, but you could put your parents, you put your kids, you put your spouse. You don't have to give them the CD. You just name them as a beneficiary, and suddenly that $250,000 becomes $1.5 million. That seems wild to me, but the fact that they have that on their website, encouraging people to do that, me as a taxpayer is like, well, that, so maybe it doesn't matter. Maybe our government's just going to bail people out no matter what. Eventually, we're going to run out of money, but it's not going to be my money. It's your money. So you're the guys that should be worried about this. I'm retired and I can go to Costa Rica and live on bananas. Huh? Yeah, if y'all don't mind the inflation. So the Fed now is in this issue of bank crisis, and we'll see. Obviously, the banking industry is reacting pretty radically now. Credit Suisse is interesting to me. I can't believe UBS would buy Credit Suisse, because UBS got rid of all that stuff because they didn't want it. Now they're going to buy it. So I don't understand that, but it doesn't make sense for them not to have two banks either, does it? The Swiss have always had two banks. That's, our entire history. They're the two banks that, were around during World War II and all that. So interesting. All right. So how do we measure it? It's the most common way is we look at the credit ratings. If you're doing your bank analysis on credit, you would probably see the bank talk about internal ratings. And that's pretty common for a lot of banks. They say we do our own ratings, but it's not like they're oblivious to these other ratings. If they rate something double A and Moody's and S&P rated BBB, they're going to be aware of that kind of difference in opinion. And they're probably not going to, in fact, they're going to be probably pretty biased, skewed. They're going to know what S&P Moody's rates it, and they're probably not going to get too far away from that. So there's probably not that much difference between internal ratings and the actual ratings. There are other ways to do it. Altman Z-score is available. Bloomberg has Altman Z-scores. Bloomberg has their own that I like a lot better. It's called probability of default. The nice thing about Bloomberg's probability of default is you can get it for all entities. Altman Z, they don't apply it to banks and insurance companies, so you can't use it for those. But it's nice to have the Bloomberg rating because it applies to firms that aren't rated. And a lot of firms don't have credit ratings at all. So it gives you something, and Bloomberg will actually give you a hint of how their probability of default lines up with these credit ratings. And I've actually run models that convert, and there is a correlation between their number. You have to be real careful because you can't do a correlation between a number and a letter. So you have to convert. So what I did is I converted AAA into the historical default rate. So I just took AAA historical default, AA, and just took the historical and put that against Bloomberg's, and I compared Bloomberg's rate with the firms that were rated, and there was a pretty good correlation. I could not find that at all with Altman Z. Nice thing about Altman Z, if you go out to Wikipedia, the formula is out there, so you can actually see it. On the Bloomberg, they're pretty transparent. So if you want to know exactly how they're calculating it, you can get the calculation and you could actually use that. So if you've got to do this internally, you could just steal their model if you wanted to. It doesn't have to be correlation to the rating agencies. The advantage of the rating agencies is that they actually go and visit the firm, interview management. They do a lot more than just quantitative. So it's a little bit more extensive. The downside of rating agencies is that they're paid. So when I was at USA, I think we paid them $60,000. So you call S&P and say, we want to issue debt, we want it to be rated. You're going to pay them $60,000. Obviously, they want to have your business, so it doesn't mean they're going to give you a good rating. You can be rated and you don't like the rating and say, you know what, we don't want the rating, and you're just listed as not rated, which is most people interpret as means, well, you must have gotten a really bad rating. I don't think generally that's an issue except for in 2008. So how did this blow up in 2008? Well, if S&P and Moody's comes to USA, there's not that many bond issuances for them. They don't make that much money. If you go to USA Savings Bank and you now have 40 tranches on a mortgage-backed security that each one needs to be rated, you're now getting 60,000 times 40 instead of 60,000 times 2 or 3. They were making a fortune on subprime. And the last thing they wanted was to say these things are junk because they're making too much money. So I think while they rate corporate bonds really, really well, I think when it came to structured debt, I think the incentives were really messed up, and I think they misrated. I mean, their assumption was, housing prices won't fall throughout the entire country kind of thing. Is that what they really believed, or is that what they needed to believe in order to keep this money machine coming in? So I think there were some issues there, and they have been criticized for that. So that's really what we're looking for here. So this is the only math problem other than the VAR problem on the second exam. It should be a pretty simple question. So your expected loss on a bond should be your probability of default times 1 minus your recovery rate. So pretty straightforward. We can get probability of default because it's out there for free. Moody's credit, what do they call it? They have a default history. They publish a study that you can get every year. I don't know if this is it or not, but they publish a study, and they used to have the entire report, all 200 pages or whatever, that you could get for free. I don't know if that's still the case today. I have some of them out there from prior years that I've kept. S&P has done the same thing. They look ominous when you look at them, but when you actually get into them, it's a lot of numbers and charts that are just telling you, here's the default rates on AAA for the last 50 years. Here's a default rate on AA plus for the last 50 years, every single year. Then they have 20 pages that show you all the defaults that happen in this year. So it's a lot of data that you're probably just going to skim through. A lot of really powerful stuff. If I were interviewing with a bank credit department, I would probably get the Bloomberg or the Moody's default study. You can find it. And I would probably read it, even though it's a lot of pages. I would probably read it because it wouldn't take you as long to read as you might think. But it's out there somewhere. I just don't know exactly where it is. And they're probably forcing you to pay for it now versus in the past. I'll find one and show it to y'all because people are pretty fascinating. Having one that's 2 or 3 years old, I don't think is that big of a deal, because what you're trying to do is get the methodology down and the understanding, and in a few years it's not going to make that big of a difference. So the spread you're paying, you're receiving on a bond is supposed to be, since you're assuming treasuries are risk-free, can't have default, that spread is covering you for this. So the question is, are corporate bonds paying you enough spread to cover you for that? So if we look, the latest one I have? Here we go, November. So in Bloomberg has a ticker for each rating. So AAA, they're not the friendliest tickers in the world. For AAA bonds, the ticker is LU3ATRUU space index. For AA, it's all of that, but 2A, 1A, BA, and then you have your high yield. So they have these, they probably have something for the A1s, A2s, A3s as well. So you can get down to the subcategory if you wanted to. I brought it in monthly. You can bring it in daily. You'll notice you bring it in daily, especially when you go back too many years, it stops changing. So you get a sense that they don't have that kind of detail. But they do have it back monthly, quite a few years. So you can look at it over time and just see, here's AAA. And the amazing thing with AAA in 2008, the spread got up to 160 basis points on a bond that almost never defaults. So you're getting paid an extra on something that normally pays 20 basis points. You got an extra 140 basis points in that year. High yield. Do you think you'll be able to see 2008 on high yield? Maybe. Does it stand out? An extra 18% spread. You normally get what, 5%? And suddenly in 2008, you're getting 18% spread. Should you have bought the high yield right here? Would that have been a good investment? Absolutely, right? Spreads gap it come in from 1800 to 500. That's amazing. I bought high yield that year. They were up as much as the stock market was. They're up 70% in 2009. It was a pretty amazing year. Our high yield bond manager, he was convinced that the spread on high yield was higher than the equity risk premium. He was saying people are getting paid more to loan money to a company than they were to buy the stock, which makes no sense, obviously, because if the company goes under, you'll get some money back on the bonds, you'll get nothing on the stock. But he was convinced you're getting a higher risk premium on the bond than you were on the stock because they were so ridiculously mispriced. So 2008 stands out. Does the last few years stand out? We got to some pretty low levels on spreads in the last few years. It's starting to gap up a little bit, but it's still pretty low levels. This is high yield. You know, we're talking 4 to 5%. It's not giving you that much spread, but we'll have to look at it versus the default rates. So this is the entire question on the exam. Let me make up some numbers and then we'll look at some actual numbers. Let's say the spread on a triple B, let's say is 160. Let's say the historical default, let's say is 2.5% over 10 years. Well, I'll even make it higher. I know it's not this high, but I'll make it higher. Let's say 5%, 10 years. And the recovery is 40%. So is that spread adequate to cover your risk? All right. So the key is this 160 is received every year. You're getting that extra 160 every year, right? If you bought the 10-year treasury at 4%, this bond's going to pay you 5.6%. For the next 10 years, you get 5.6 instead of 4. So you're getting an extra 160 basis points every year. The default is 5% default, but that's over 10 years. So what's your average default? 0.05 divided by 10 or 50 basis points. So your spread's 160, your default rate is 50 basis points, but you're not going to lose 100% of that. How much are you going to lose? You're going to get 40% of that back. So you're going to lose 60% of that. So you take 50 times 60%, It equals 30 basis points. Are you getting compensated for your risk? Well, on the exam, what would you say? More than adequate compensation for the default risk. But is default risk the only risk we have under credit risk? We also have downgrade risk. We also have spread risk going to recession. I mean, you see it right in the numbers, 2008. You would have lost a lot of money on this bond in 2008 because spreads would have gapped out the 500, 600 basis points. But over the long term, corporate bonds do pay a pretty hefty spread over your expected loss. Any given year it can be bad. And the bad thing about corporate bonds is they're much more highly correlated to stock market than treasuries. So you have that correlation risk that some people ignore. So from that standpoint, they're not as well diversifying as treasuries, but you do get compensated. This is the reason I got in so much trouble buying treasuries when I started off on the fixed income side. Is USAA, we don't buy treasuries. They don't pay enough. You get more than enough spread buying corporates, and we can manage this risk by making sure we buy, high quality, or the ones that we know are going to mature. So where can we get this data? Well, S&P, Moody's, they provide this information. They have what they call the transition matrix. They show you how many AAAs went in default 1 year later, 2 years later, 3 years later, 4 years later. Now they'll argue no AAA or AA has defaulted ever. That is true, but I think if you went back and looked at Enron, I think it was AA rated a few months before it defaulted. When it defaulted, it was D rated, but a few months before it was double. So it went from AA to D like really fast. So for them to say no AA is defaulted, yeah, that's true, because by the time it defaulted, they had downgraded as fast as they could. So that's not what you're looking at. You're looking at what's the chance that bond that's rated AAA today will have defaulted 10 years from now. And that has happened. We have had some AAA bonds. Now, how many AAA bonds do we have left? I was looking at that earlier. We're down to 2, aren't we? Johnson & Johnson and Microsoft, isn't that it? How many? So Microsoft doesn't really need any debt, do they? Did I spell it right? I always switch it. Financials, balance sheet. So they have $130 billion in cash. And they got another $6 billion in short term. So $130 billion in cash. And $60 billion in debt. Maybe a little more here. Yeah. So they got $70 billion in cash, $140 billion in cash. They don't, why are they even rated up? I mean, why don't they just pay off all the debts? So yeah, that kind of makes sense. Johnson & Johnson, I'm not really sure why they're so highly rated. I don't really know that firm all that well. They've got $32 billion in cash. And they got 30, so I'm not sure why they're so special. Anybody know why is Johnson & Johnson so special? Why are they better than, I don't know. Well, I know why they're better than Bear, but why they're so highly rated. USAA used to be AAA not that long ago. So yeah, there aren't that many AAAs left, but AAA bonds, we'll see over 10 years, about 1% or so go default. The recovery rate's pretty high. It's about 60%, and that's part of what the rating agencies look at. They're not just looking at default, they're also looking at what happens if they default. You can get 80-90% of your money back. Even Enron, when Enron defaulted, people got some of their money back. It wasn't like you loaned them $1 million and you lost $1 million. It may have taken you 5, 6, 7 years to get your money, your 40 cents or 20 cents back on the dollar, but you did get some money back. So it's rare that the recovery is zero. You get nothing unless you're just really, really subordinated debt. So this is the math that you're looking at. And when you look at the math, yeah, corporate bonds look like a pretty good. They're covering your risk pretty well. All right, let's get into mitigate. I'll show y'all we're running low on time. So I'll show you an actual exam math question next class. So how do you mitigate it? Risk limits and concentration limits. It can be to any one issuer. It can be by industry. I should have put in here by rating as well. So this is the most common. Say we don't want more than 2% in any one entity. We don't want more than 20% in the financial services industry or in technology. In 2020, it was energy. Everybody's worried about energy. Everybody's worried about consumer stocks, in 20, especially travel stocks. This year, it's banks all of a sudden, or tech companies, or so it kind of moves around. So let's not have too much exposure in any one particular entity and one particular industry. Look at it by rating. You can have aggregate limits as well. We did this at UTSA. It got pretty complicated. To say we don't want to have more than 5%. I forget our number. I think it was 2%. We don't want more than 2% in any entity in any form. So I have a swap with JP Morgan. And if we're also loaning money to JP Morgan, and then if a real estate company has an office leased out to JP Morgan, we got to add all that together. But how do you do that if you got hundreds of vendors? So what I did is I told each entity, send me your top 50 exposures, and then I matched them all up. I was assuming if anything was not on anyone's top 50. Now it's possible number 51 was the same entity for every single person, but I thought that was highly unlikely. So I just assumed if anyone wasn't in our top 50 in one of our entities, it was not on our list. And so I brought it all together, matched it up, and we started finding what was our highest exposures. And I brought the report in of our top 10 exposures. We had a new CEO, and I go to Bob Davis and I'll say, what's the max exposure you want to say AA? Or actually what I did, I went to Bob Davis and said, I'm proposing 3% is our most any one AA. So he goes, that's too high, go rerun your models. And I go like, I don't have any models, but okay. I didn't tell him that. So I wasn't even thinking I had like this sophisticated simulation model, but I didn't. So I went back to my desk and I took 3% and I reduced it to 2.5%. And then I went back to him and I said, what about 2.5? He said, no, that's too high. Go run your model again. So I went and ran my model and then it came out at 2% this time. I had to erase the 0.5 and go back to 2. He's like, it's too high. I said, okay, there's nothing I can do. You tell me what you can sleep with at night. What's the number you can accept? He gave us a number that was so low, so I called the bond guys. Oh, they were mad at me. I was like, hey, I have no authority here. And so it had a huge impact. Our top 10 had some massive exposures. And our bond managers that were used to buying 50, 60, 70 securities, I kid you not, had to buy 500 plus securities. That changed their workload, didn't it? They were so mad, except for a few years later, because our top exposure, you may want to guess what was at the top of our list. We had a huge exposure to Enron. They were so mad they had to dwindle that down to a small smidgen. And then Enron went under. I remember them calling me and going, maybe he's not as stupid as we thought he was. Maybe he knows what he's doing. But boy, that had a huge impact on us. Because there were a lot of articles written about insurance companies having too much exposure to Enron. We weren't one of those companies. Was it pure luck? Because he didn't say this because Enron was on the list. He didn't care Enron was on the list. He was just like, I don't want that much exposure to one entity. So, maybe he knew what he's doing. It did radically change the work. So it gets back to what we talked about in diversification. It's a lot easier to do research on 50 than 500. Is it more risky to have 500 because you don't have the in-depth knowledge of those entities? And that's kind of that familiarity versus diversification. So we went the diversification route. And then what happened was all our corporate bonds dropped off the list, and then we're stuck with our top 10 list was all reinsurance companies. And there we had no choice because there was nothing else we could do. And then the actuaries are like, what do you expect us to do? We got Swiss Re, we got Munich Re, we got Gen Re, and they're the biggest players. We're buying billions of dollars of reinsurance. What do you really want us to do? And there was not much of a solution there. So entities go through these discussions, these debates, and they got to come up with some number they're comfortable with. There's no obvious answers on this. This is why credit risk is so difficult. You look for strong covenants. What's going to happen if they get bought out, get taken over? What happens if their earnings fall? Can we keep them from paying dividends if they don't hit certain covenants? Those kind of things. And then we have the CDS. I'm not a CDS person. I've never done CDS. They don't make sense to me. Every time I look at them, they look like options, but they're swaps. So my brain can't, there's certain things my brain just can't handle, like currencies, and I love swaps, but credit default swaps are really difficult. Obviously, this caused some major problems in 2008 with AIG. So credit default swaps. So why is it a swap? So I think about it as you're buying insurance, which buying insurance, that's an option, but it's a swap. So essentially what they do is you're paying LIBOR and they're going to pay you whatever payments the other entity didn't make. So it looks like a swap, but in a bigger picture, to me, it feels more like an option. It feels more like insurance. Swaps are interesting. You should probably go out and do some analysis on Bloomberg on swap spreads because they're pretty interesting. I showed you the pension plan for USAA where swap spreads really gapped in 2008 when everything else gapped out. So it gave us this huge windfall. There have been times, like we're going to talk about long-term capital management in 98 when swap spreads gapped out and went really high and caused major havoc. So credit default swaps are an interesting beast. You can use swaps as an early warning. If you think about this early warning, I may have this later in the notes. I should have looked ahead. So early warning, what does an early warning mean then? So you're watching the bond, you don't notice anything, and then suddenly the swap spreads gap out. So someone's telling you something is going on with this entity. If you have that up on your Bloomberg screen and you see it and gives you a warning, say, hey, why did their spreads just gap out 50 basis points all of a sudden? Did some news come out that we didn't see? Hopefully your trade desk is catching all of that, but if not, why did that happen? So what else could be an early warning? Option premiums. Could you use the option market to help monitor your credit exposure? What happens if put option premiums gap out on your entity? That means the option market saying there's something risky going on with this entity. You as a bond investor, you want to know that. The stock price drops 40%. Okay, could that mean there's a credit issue going on? Absolutely could mean that as well. Obviously the bond price itself and spreads, that you're going to be aware of every single day because you're watching that. But I recommend if you're in an asset class, use the other asset classes, put them on your Bloomberg screen. So if you're watching a particular stock, it's in your portfolio, you might put their spreads, you might put their CDS spreads, their OAS spreads. You might put that on your screen. And so if something, 99% of the time you're going to ignore it, but that one time when they gap out all of a sudden, you're like, okay, wait a minute, I need to go look and check on this. It gives you some indication. So you can set up some pretty powerful stuff. If you set it up in Bloomberg, then you can let Bloomberg, you just put it in Bloomberg, and every time you load the file in the morning, it sends you a message or does something that tells you you need to do something, and it let that do your work. You usually let the trade desk do that for you, but they can miss things. So that's the mitigation. With USAA, we had a new CEO who was incredibly risk adverse, so it was a learning strategy. Our investment policy went from 2 pages to like 70 pages under him. It was just, and when we first did it, the investment people just ignored it. They're like, we have a new investment suggestion. So no, you have a new investment policy. Yeah, but we don't really have to do that. So yeah, I think you do. So they just ignored it. I remember, can y'all imagine the first meeting when I told the CEO they're complying with it when they want to. I don't, I think it's the only time I've seen a 6-year-old man throw a table across the room, but he was pretty lividly mad. They didn't violate it after that anymore. They were right on it, but it was pretty picky. And he was so picky. I remember once he got the new policy approved by the board, and on the flight back, he was flipping through it and he found something he didn't like. He calls me and says, we got to change this. And I said, you just got it approved. We had to change it. They had to go back and get the board to reapprove it. It's like, would you stop looking at this stupid thing, please? It's just, we got to get this thing done. But it was, yeah, very different. So we went from a world where no one cared. And who wrote the policy at USA? The investment people wrote the policy. The people who are being controlled by the policy wrote the policy. But we went from that world, 2 pages to 70 pages, a new CEO who was very picky down to the, every single word had to be exactly right. Very, very different. And then you get a new CEO. We're going to talk about that a little later, how important the leadership of your firm is to risk management. You also talked to John Toohey. That was in John Toohey's class. Has he talked to you about AIG at all? Is he too embarrassed to say he worked? He had nothing to do with that whole thing, but he does have a pretty strong opinion about Greenberg, because Greenberg was a lot like Davis, a micromanaging CEO that was a tickler for risk. USA had that, and then you have a new CEO, and guess when AIG went under? New CEO, not a micromanager. Do you want a micromanager as a CEO that's in every single decision? So maybe that's bad 90% of the time, but in the 10% when everything's crashing, you're kind of glad you had that. Who knows? That's kind of the debate we had at USA. It was very interesting. I remember the most awkward. I'm putting all this on tape, but I don't care. Have Bob Davis, if you're watching this. But I remember one exec council meeting, they were talking about Greenberg and how micromanaging he was. And boy, you could sense the whole tension in the room because we had the exact same CEO. And they were talking about how bad it was being micromanaged like that. And he's going, yeah, that's not good. It's like, yeah. But I'm not saying one's right or one's wrong, but he's certainly saved USA some huge losses because of that micromanaging. But he also caused a lot of frustration with the employees having to deal with all this new detail. So I don't know, you got to pick which of those CEOs you'd rather work for, and you got to decide in the firm. So credit ratings, you should know your credit ratings. Make sure you know. So what is that? S&P or Moody's? Three capital A's. That's S&P. What's the only one that doesn't use all caps? That's Moody's. So Moody's is the cap and 2 smalls. So that helps you. Fitch helps. Everybody else is all triple. It's all high levels. S&P's pretty easy. Extremely strong, very strong, strong, adequate. And then you start getting into, vulnerable. Pretty straightforward definitions. They will argue that the ratings are always current. It's true they have a big presentation time frame. They go and visit the firm. It's not like we've confirmed the ratings or we're keeping them. They say the ratings are absolutely current every single second of the day. It's not just that they reaffirm them when they do the big presentation. So they don't say the ratings are better now because we just visited. They say they're good all the time. I usually classify all the A's as high quality, triple B is medium quality, and obviously everything below triple B is junk or below investment grade. There is a huge difference though between double B and single B. Once you get below triple B, they start dropping off pretty fast. And single B is much, much, much riskier than a double B. So this isn't some linear thing. A triple A is extremely safe, far, far different than a triple B. Now these 3 are somewhat similar, especially triple and double. There's not a huge difference in those 2. So double B to single B is massive. Triple A to double A, not that big of a difference. So it's not like each rating drop is the same type of risk increase. Moody's is a little bit wordier, so it's say the best quality, but what does that mean? Best quality, if everything's bad, that's not all that good. And then they have all these extra words, and they don't have triple B, they have BAA. You may hear it called BAA, you may hear it called triple B, but they have little A's in there. But it's essentially the same. Is it possible that Moody's would have someone BA and S&P having triple B? Yes, it's very possible. That's called split rated. So then you have to make a decision. Is a split rated investment grade or is it below investment grade? We had to put that into our policy. So we would define investment grade as both entities had to have them investment grade. So if it's split rated was below investment grade. Some firms may not do that. So you got to make those kind of decisions. We did have some below investment grade, but most of ours, you know what they're called? What is it when a triple B is downgraded? I know that term, fallen angel. Have you ever heard that before? Fallen angel, is that something weird? If you hear the term fallen angel, it's usually when they go from investment grade to below investment grade. It doesn't mean double A gets downgraded to single A. It's a triple A gets downgraded to double A. So do you have to sell? So that's the other decision you have to make. If you say we can't hold high yield, do you mean we can't buy high yield? Does that mean if like triple B gets downgraded to double B, you have to sell it immediately? Even if it's a fire sale, we had to get all of those decisions into our, you can see why the policy went to 70 pages very quickly. Do you want to tell your bond manager, hey, if it gets downgraded to double B, you got to sell it within 30 minutes? Do you want to sell something that just got downgraded to high yield? Probably not. That's probably pretty illiquid. Do you give them a week? Do you let them hold on to it? They think it's pretty good. Those are all the decisions we had to make, and we had to put all that into the text so the bond manager knew what to do. Once you get a bond that actually, like Enron, we did hold some Enron when it went under. It was really small. I think it was down like 40 million bucks from several $100 million. So it got pretty small, but it's still $40 million. You still have to do something with that. You have to be on a committee. You go to the committee and you have to negotiate who's going to get what. It's time consuming. It's almost not worth the trouble at that point. But you have to decide how you're going to handle all that. So, all right. What I'll do next class is I'll show you an actual math problem from the last exam, which is probably the easiest question on the last exam. I don't know if any of y'all thought to go to Silicon Valley Bank's annual report and read their risk management section. You'll notice it's not nearly as extensive as JP Morgan and Bank of America. They all have an ALCO, right? Asset Liability Committee. USAA had an ALCO. This is a common term. So market risk is defined as the risk of adverse fluctuations in the market value of financial instruments due to changes in market interest rates. So they're only focused, on interest rates here. Changes in interest rates can influence the rate of principal prepayments on mortgage securities, which is one of the risks they took, which affects the rate of amortization. Our market risk includes foreign currency exchange and equity price risk. These risks and related impacts are important market considerations, but are inherently difficult to assess through simulation results. That's not really true. This is something we've gotten, we're bad at a lot of stuff in finance, but modeling interest rate risk is something we've gotten quite good at. Consequently, simulations used to analyze the sensitive net interest income to changes in interest rates will differ from actual results to the difference in timing, frequency, rate resets, blah, blah, blah. It's managed through their ALCO. They review the sensitivity, market valuation, earnings assets. Now, what's interesting is they have the chart, almost the exact same chart that we had. They go 2 and 100 and 200. Some of your banks only went down 25 still. I think most of them are doing, most are doing 1 up +1 and -100. But all they're looking at here is the net interest income. That interest income is not as sensitive to changes in rates as the economic value of the bank, and that's what destroyed them, was the economic value of the bank. And they don't even show that. They talk about it. It's in their discussion, and they say they run scenarios on it, but they don't provide the information. So model simulations. So they don't give us EVE. They give us NII. But just not much information at all, and that's it. That would have been a lot easier paper to write, wouldn't it? and your final conclusion is, oh, by the way, they're insolvent. So my recommendation is that, you know, my assessment is that's probably not a very strong system. That would have been pretty easy, but it's only a couple of pages. I mean, it's just ridiculously short. That may give you some indication. Most of my career, I had this thing of all these people are so sophisticated. I learn all this stuff, and then you discover there's some pretty big organizations that are not that sophisticated. It's kind of shocking. So don't assume most of them are. I mean, you go to JP Morgan, obviously there's going to be some really incredibly smart people there, but don't always assume that. It can be pretty amazing. So I mean, I remember coming from the CFA exam, I was so excited because I did exactly what we did on exam 1 with the balance sheet immunization. So I go to our bank's ALCO committee. I beg them, let me sit on the committee. And I'm sitting there, I'm just kind of curious. And I mentioned, hey, I studied all this stuff on the CFA exam. Like, hey, what did you study? And I showed them. They said, oh, we've never seen that before. And I was like, wait, I thought you were the ALCO committee. That's kind of shocking. Hey, can you teach us that? I was like, no, I shouldn't be teaching you that because I'm just a green kid out of college, but it was kind of scary. So, all right. So let's do a couple of these questions. This should be a give me question on the exam. But I want you to have to memorize it for the exam because I want you thinking about it. It is a fairly simple concept. I might update this chart because I do have better numbers now. I just didn't update it for this last exam. So we have different rating categories and we have the default rates. So this is missing the recovery rate. So you're not going to lose this much. This is how much defaults, and then you'll get some of your money back. And there's a time value money that we're going to ignore. Like when Enron went under, you got some of your money back, but it might have been 5-year, 6-year delay. I'm ignoring that time value money on the recovery, but there is some delay there. And so if you look at the 10 years, which is what I'm focused in on, I don't know if I say 10, yeah. So BBB bond, 10-year corporate bond. So if you look at the 10-year, this is the default rate over 10 years. It's not 0.87% every year, but over 10 years, 0.8, less than 1% of the bonds that are AAA rated starting today will be insolvent in 10 years. Everybody understand that? See how that works? So very low probability. It jumps to 2.5% on AA, 3.6, and then you notice a huge jump when you get down to BBB, and then the massive jump when you get down to high yield. That's what I was talking about. It's not like stepping down. It's a pretty extensive jump. So what that means is, if you take 0.87% and you divide that by 10, you're expecting defaults of about 8.7 basis points. So if you get a spread of 8.7 basis points, you've essentially covered all your default risk with the extra spread. For AA, 2.5% over 10 years, so about 25 basis points a year. So if you get a spread of 25 basis points, you've covered that. 36 basis points, 71, 190, 350, and 531. So, it gets up there pretty high. They show you for investment grade versus non-investment grade. So let's look at the question. Historical recovery rates have been as high as 60% for AAA, but tend to be about 40%. So AAA has the double advantage that they don't default, and when they do default, there's a lot of pretty good assets there that you can get a lot of your money back. So let's say a BBB bond has a current spread of 170 basis points. Comment on the adequacy. So this isn't really a lot of math. There's some math involved, but the math is pretty straightforward. So the default expected loss is going to equal, so BBB has 711, so 0.0711 divided by 10 years, that equals 71.1 basis points a year average default rate. So you expect about 71 basis points in defaults every given year. So if you get paid 71 basis points, that would cover that. net of recoveries. So you got 71.1 times 1 minus 40%. So you can get 40% of it back, so you're going to lose 60%. So how much you're going to lose, you do that math, whatever it is. I have to do it. So you get 42.66. Did I do that right? Someone double check me on the math. So 60% of 71 basis points is about 43 basis points. What does that mean? Any given year in triple B, you would expect to have net losses of 43 basis points. So if you get paid 50 basis points in spread, then you're making more than what you need just to cover fraud defaults. You're actually making 170 basis points. So you're more, and that's what we talk about. You're much more than adequately compensated for the risk, but there's a couple things you want to mention. Whoa. More than compensated for the default risk. Ignores what? Downgrade and spread risk. I mean, downgrade risk, I shouldn't say that. Downgrade risk is part of your default risk, so I really shouldn't say that. But spread risk, because on that 42 basis points, those are all going to be downgraded securities. But spread risk and recessions, you know, so spreads are going to gap out during a recession no matter, you know, what the bond ultimately does. So that's all price risk. So some of that 170 basis points is covering you for the fact that just these bonds can fall dramatically in price, and they're going to do it during a recession, which is when, you know, your stocks are going to be doing poorly. So it doesn't help with your diversification in the stock portfolio. But I want you, and you're just to realize corporate bonds pay pretty rich spreads compared to their history. It's an important thing to know. Now, if you go back and look at some of these corporate studies, they have annual numbers. You can go look at the worst case. So that might be the other thing to think about is the tail risk. You know, yeah, on average, I expect to lose 43 basis points, but what would a really horrible year like a 2008 be like? 2008 was horrible on the spread risk. And there were some pretty significant entities that went under in 2008. All right, so real simple question, right? There's not much to it. The main thing is to get this essay down. Let's try another. Any questions on that? Now, I need to update this. Updated it. This is the kind of thing I would carry in my wallet. I want to know AAA's default about 1% over 10 years. Double A is about 2.5%. Well, up here it says 40% are going to recover, which means 60% is going to be lost. All right, so you'll get 40% of your money back. So how much will you lose? You won't lose 71. You only lose 43. Yeah, there's certain numbers, you know, like that 6.5 basis points is one standard deviation on the 10-year treasury, 1% is the standard deviation on the S&P. There's just certain numbers. The spread between the 10 and the 2 being about 70. There's just certain numbers you should just know. You should just have a card you take with you everywhere. Maybe we should develop an investment society. The key historical numbers. I have this theory that college students don't know when to gasp. They don't know when you should be shocked. If you see a number, oh, the stock market was down 4%. Okay, no, that's 4 sigma event. That's a big event. 10-year treasury off 40 basis points. No, that's huge. Also knowing what these normal spreads are, and you know, are we higher than average, below average? There's a lot of things you can do. to get yourself prepared for an interview, especially if the day of your interview, something big is going on, you need to know about it because that's what we talk about in finance. And you need to be ready to know that, man, something really, really big happened today. You don't want to walk into an interview and they say, well, what did you think about the treasury market today? And you have no clue what's going on. That's just not going to be good. It's understandable, right? You've been stressed out about the interview all day, so you don't even look at the TV, but you can't do that. You got to run out and look at the TV real fast before you go to interviews, so you know what's those major things going on. All right, let's try another one if there's no questions. So here's an A-rated bond. Again, the 40%, so A rated. So 362 basis points or 3.62% over 10 years. So you take 0.362 divided by 10. That's about 36.2 basis points. 36.2 times 1 minus, again, 40%. So 19 point something, I can't do that math. 36.2. $21.72, and yet you're getting paid 60 basis points. And remember that 60 basis points, you're getting that every single year because that's the spread you got when you bought the bond. So you're always getting that spread every single year. So you're getting 60 basis points risk premium when your expected credit risk is 21. Now, what spread are we talking about here? Anybody know? We're probably talking about this in John's class. What does he call it? What if this is callable bond? Callable bond has a higher spread because it's callable, but is that in the 60? It's not in the 60s. So what do we call this spread? I need two words right here. Okay, remember those two words? Yeah, remember option adjusted spread, OAS? Why should it be OAS, not the actual spread? Anybody? Some of you are in John's class now, and some of you had my investment class. So OAS, y'all can look up OAS in Wikipedia. Although I've seen some sites that give the definition completely wrong, at least from the way I was trained. So I don't know, I have to check with John and see. So OAS of a security can interpret the expected outperformance versus the benchmark. They're not actually telling you yet. Yeah, I mean, the right answer, I'm not sure they have the right answer in here. In fact, I think I've seen Investopedias. So y'all should ask John this. Who's in John's class? Yeah, and Anna, you could ask them. So my definition of OAS is the spread on the bond if there were no options. So essentially it's the credit spread. The OAS is the spread you're getting to compensate you for credit risk. Now, if there's an option in it, they can prepay, they can call the bond, those type of things. You have to pay an extra spread for that. That's the option spread. The OAS takes the spread of the bond and subtracts out the spread you're getting for the optionality. So it's only the credit side. So that's why this should be the OAS. I've actually seen some people define the OAS is that's the spread you're getting to compensate you for the optionality, but that to me is completely backwards. And I was trying to find that in Wikipedia, but they're so squirrely worded here. I don't know how often how often you think this page gets edited by someone? You think OAS is a real popular one? Obviously, convexity comes in anytime you have optionality. The terrible definition here, so I'll take it back to Wikipedia is good. They never actually define. They never actually defined it. Let's try Investopedia. The option spread is a measurement of the spread of a fixed income security, right? Of a fixed income security. The spread of a fixed income security rate. I don't know what that means. Does that make sense? They need to edit their side a little better. The spread, maybe they should set its yield and the risk-free return, which is then adjusted to take into account embedded options. They still haven't told you yet. The option spread measures a difference in yield between a bond with an embedded option with that of the treasuries. Embedded options are provisions. West considers how bonds embedded option can change. Yeah, none of that's correct yet. Yeah, they're avoiding telling you what it is, this entire page. Have y'all seen a definition yet? They keep saying it's adjusted for, but they're not telling you what the OAS actually is. All right. So I was taught when I did the CFA exam, and I did well in the CFA exam. I was taught the OAS is the credit spread. It takes out anything you're getting spread wise to cover you for the options. All right. That's why I used to ask the question, why do Ginnie Mae's and OAS? And why would that be a good question? What are Ginnie Mae's? They're mortgage-backed securities that are full faith protected by the U.S. government. So how much credit risk should there be? Should be zero. So there shouldn't be an OAS, and yet they have an OAS. So that's the reason I would ask that question. I always loved asking that question from Dee. Dee ran our largest bond fund when I was there, PhD in math, really smart lady. I love asking those kind of questions. And she couldn't. My opinion is what the OAS on a Ginnie Mae is really reflecting the errors, potential errors in the option model. That it really should have an OAS of zero because there is no credit risk with the Ginnie Mae. The government's going to step in and bail you out. So there shouldn't be an OAS. Its OASs are really thin, which confirms my definition of OAS because Ginnie Mae's have a lot of optionality, so they should have a wide spread, but their OAS is really small because there's practically no credit risk whatsoever. All right. Boy, this is frustrating. Someone needs to define good definition. That's what I should have put in there. What's going to come up?
I found something on Wall Street module. If you scroll down, you will see it on one of the. That's the Wall Street module. Go down, three more down. There it is. Has some of the definition in the.
Yeah, it's still, they just won't tell you what it is. So
It doesn't go that deep to it.
it's kind of frustrating.
It shows the formula also.
So I mean, I don't think the definition is that complicated, is it? If this bond didn't have an option, this is the spread it would have. That's the option adjusted spread. They're not saying that. They're saying it's adjusted for the option, but adjusted how? So taking that out, they never say that. They should adjust it for the optionality about taking the premium for the optionality out of the spread. That's what they should say, but they don't. OAS is a pretty important concept. Have y'all talked OAS at all in your class yet? Have you done mortgage backs? And so yeah, it'd probably come up. So what textbook are you using? The Bosey or Tuckman or? Okay. All right, so I'll have to see get his definition. Let me know. So this should be the OAS. So we don't want the total spread. The total spread for this bond might be 98. So you're getting 60 basis points to cover you for credit risk, and you're getting 38 to cover you for the optionality that you're providing so they can prepay the debt. But here we're only looking at the credit risk. And so you want to take out that optionality entirely. Now, a lot of corporate bonds have no optionality. So the OAS and the spread are exactly the same. There is no extra spread because they can't pay off early. They're not a callable bond. But it is the OAS. If you're not used to the term OAS, start using it more, but make sure you got a good understanding of the definition. So you need 21 basis points, 22 basis points, and you're getting 60. So you're very well compensated. Where the models that they're talking about really focus in a whole lot more on is that the extra 38 basis point is enough. That's where the complexity comes in. That's where I disagree with SVB. Maybe that's what they meant, was the optionality side of it. The credit side is pretty easy to understand because you have all this incredible history from the rating agencies on exactly how much you can expect in defaults and recoveries. So you're more than, it's the exact same answer I had before. You're more than compensated for default risk, but ignores the spread risk, the fact that spreads gap out and come in during recessions and price risk. And then it's possible there's some tail risk or something just incredible happens, but that's almost true of treasuries too. You know, something completely wild happens that, you know, the whole world comes to an end. If our sun blows up, becomes a white dwarf, then yeah, these bonds are not going to pay, including treasuries. So everything's under, so, you know, some extreme tail event. You have to pick your tail events. If the world ends, that's kind of an extreme, too extreme of a case. All right, so this should be a gimme, but where students lose points is just not enough discussion there. There's a good discussion in the class notes on that. So just make sure you're clear on that. And you have, this is not one you do open book. This is one, it's on, you know, some of the questions will be open book, but this one's not. So you got to make sure you can write this down in your own words. All right, questions on that? I'll get some updated numbers on these. It was pretty interesting looking just about a year and a half ago. Credit spreads were incredibly low level. In fact, that's why I'm very confident OAS is exactly what I'm saying, because when I pull it in from Bloomberg, I'm pulling in OAS, and it's pretty obvious that's an OAS and not the option premium. On mortgage backs, what I've always taught on mortgage backs, the option premium historically has been about 25 basis points. So if you borrow money on a house, your right to pay off that house early is costing you an extra 0.25%. Now, at any given time, that can be higher or lower. Right now, last time I saw it was more like 40, 50. When interest rates are volatile, it's going to be a much higher premium, but on average, over time, it's 25 basis points. So you're paying, you know, if your mortgage is 5%, without that prepayment, you're going to have to pay 5 1/4 to give you the right to pay off the mortgage early. But that number can move around quite a bit as well. All right. So we're going to now jump to a bunch of other risk, and it's going to get a little kind of just bouncing all over the place here. Next week, we'll do some interesting things, kind of unique, but I'll set them up in advance. All right. So we've done interest rate risk, price risk, liquidity risk, and credit risk. Those are the 4 big ones. Credit risk is the one that normally blows banks up. Although it looks like Silicon Valley got blown up by interest rate risk, but most banks handle interest rate risk pretty well. It's usually credit risk, but there are some other risks out there. We're going to start with basis risk. We actually have an entire case on basis risk we're going to do, talking about a company in Germany that went under because of basis risk. So what is basis risk? Tracking risk. We talk about tracking risk related to your portfolio. It's a similar concept. So you're trying to do a hedge, and you set up the hedge. You tell your boss, hey, we're hedged. Don't worry about it. Everything's fine. And then the thing you're hedging falls 20%, and your hedge is up 5%. So your boss comes in and says, man, I'm so glad we hedged that. Says, well, we got a little bit of a problem here. Well, I know the portfolio is down 200 million. Yeah, the hedge is up 50 million. So sorry, we didn't quite hedge it very, very well. That's not what you want to tell your boss. It's interesting listening to the CEO of Merrill Lynch. He kept telling people, we're fully hedged, we're fully hedged. I don't know if he actually asked anyone, but fully hedged. What does fully hedged mean? Fully hedged means we just won't lose any money. It didn't mean everything was actually hedged. It's just like, yeah, we obviously, our traders know what they're doing. Not really, nothing was really hedged. And he kept telling people that we're fully hedged. That's not even tracking error. That's just not knowing what's going on in your business. But you had something. Now I showed you with the USA pension plan, we had a basis risk that came into our favor. We hedged and our pension plan fell and the hedge went up. That was just pure luck. But if that had gone the opposite direction, it could have been really, really bad. So you have this hedge, you tell everybody everything's fine. So it's almost worse than it could have been, because everybody's happy, like we're hedged. They're coming in the office, everybody's skipping, they're so happy they're hedged, and then suddenly they discover the hedge is not all that good. Some good examples are these VIX ETFs. I don't know if I can find a good one. Here's a ProShares. What's the ticker? VIXY, VIXY. On my 90th birthday, I'm going to come in Yahoo Finance or Yahoo, and Donald Trump will still be the lead story. He'll be 140 years old, but so here's the VIXY. Let's see if it will let us do a comparison. I'm not sure it will, but we'll see. So here's the VIX. 2261. Here's the VIXY. What do you notice? It tracks pretty well, doesn't it? Except for on the extremes. If you bought the VIX thinking, hey, the VIX, when it shoots up, markets are crashing. So here's my hedge. And here you have the market, the VIX shooting up to 66, but no problem. I got this VIX fund. And it shoots up to 20 or whatever. Your boss may not be too happy. And this is tough. You know, this would be a great question for a speculative markets class. How would you actually create a VIX ETF? I have no clue. I'd have to sit down and really think about it. There's no VIX to buy anywhere, is there? What is the VIX? It's the implied volatility of the S&P 500 options. Where would you actually go buy that? You're going to somehow replicate it with options, but how would you even do that? So it's a pretty amazing thing that they created anyway. It does pretty well until when you need it. And then it doesn't do very well at all. They've had a tough time. I don't know if they've been sued or anything since then. We can look at it from this point, 316. Well, let's just go back 2 years. Well, that looks pretty pathetic. So, you know, it's pretty shaky. I wouldn't buy this thing thinking that, hey, I bought this thing when the VIX was 20 and the VIX has shot up to 80, so this thing's up 400%. I wouldn't assume that. These are really hard things to replicate. So terrible basis risk. So tracking error is the standard deviation of the return of what you're hedging versus the return of what's being hedged. So you can see how different they can be. You want an R squared of 99.999%. You want the two to be moving exactly, or negative 99. When one's up, the other one's down. And one's up 10%, this one's down 10%. And how do you measure your actual exposure as a value at risk? So you run that scenario, your R squared about me 98, but how bad could it be? That 2% where they're not moving together, how far away can they be? Is there a massive scenario where the differences are huge? So if you have data, you know, you got good data, you can go back and measure these things. So like at USA, where I was using swaps to manage our pension plan that was priced off of corporate bonds, I could go back and run the analysis between the swap yield and corporate bond spreads, pretty high correlation until 2008, and then they went opposite directions. But we'd never had a 2008 before, so it's hard to run a scenario you've never seen anything close to it before. So how do you mitigate this? You just got to test and test under extreme scenarios, and especially test it in the scenario you're most worried about. So if your hedge works really well in good markets, but works really badly in a recession, and you're buying this for the recession, then that's probably not good. So really pay attention. Nice thing is you got 2008, you got 2001, you got 2020, you've got some periods of times where things went wild. That gives you a chance to look at a tail event and see, how did this hedge actually work in the tail event? So go back and try to find that. Match what is being hedged as closely as you can to the hedge instrument. That's why we tend to like over-the-counter derivatives, like a swap. Because with a swap, you can match things. You have a lot more control. Remember with futures, they tell you the maturity, they tell you the amounts, the strikes, everything is dictated by the market. With the over-the-counter derivative, you can change the terms and make up your own security working with your broker pretty easily. So much more flexibility. But test all the way through here. Don't ever tell your boss you're hedged unless you're actually sure you're hedged. If you're buying a Vanguard S&P 500 index fund, and you're hedging it with S&P 500 futures, you're hedged. You have nothing to worry about. But if you're buying a Fidelity Contra Fund, mutual fund, and you're going to hedge it with S&P 500 futures, yeah, you've got some pretty good differences there that you need to watch out for. All right, so that's basis risk. We're going to do an entire case on that we'll see of a firm messed up on that. So the example we're going to show is a firm has actual oil, and they're going to hedge that with oil futures, and they got backwardization and contango and all this stuff to deal with, and it messed up at the worst possible time. All right, the second risk, which all of you are going to have tremendously, is model risk. We just saw Silicon Valley mentioning model risk. So you create a model is going to simplify the world, but is it to simplify the world? And one of the mistakes we really make in finance is, if the model's complex, it must be right. And you never want to fall for that. It's like, my word, look at this model, look at the formulas, they go on for blocks and blocks and blocks. I don't even understand these formulas. They're using statistics I've never seen before. Wow, this must be a really good model, because the person who ran it has a PhD in math. They went to MIT. It has to be right. So we're going to talk about long-term capital management. And that was a stencil. I mean, we've got these people with 2 MIT degrees. They're PhDs. They're very smart people. Obviously, anything they build is going to be a good model. And that gives you the garbage in, gospel out. Gospel out because it must be good because it's so sophisticated, and you got to be real careful with that. How do you measure it? Well, it's just how complex is the model. The more complex a model is, your probability there's an error in the model is going to approach 100% really quick. The question is it a big error or a small error? One thing you can do on the mitigation is test the output. This is one thing I did on one of our models. It was a stochastic model. We're running the entire company. So we did what we call the spaghetti chart. So I said, take the 1,000 scenarios. I want you just to graph them all. So let's say this is the stock market. Let me just see the stock market. And I'll look at it. And when first time I looked at it, the worst case scenario, this didn't look all that bad to me. It's like, you're telling me the worst case scenario is the stock market falls 40%. Out of 1,000 years, the worst US stock market is minus 40%. Are you kidding me? It's way too mild. So turn up the volume some on this model. It's just not nearly bad enough. Same thing on interest rates. You're telling me in 1,000 years, the highest a 10-year treasury can possibly be in 10 years is 7.2%. I mean, that doesn't make sense to me. Especially with the Fed doing what it's doing, you kind of look at it and just say, does the extreme really make sense? Check and double check your models. Boy, I remember one day I was in a meeting, the CEO sitting there, and he's questioning one of our models. And I go, no, we double checked it. We're sure it's right. But everything he's saying to me is like, he's right that number really doesn't look right. But no, we're sure. I go back, I call Melissa. Melissa, can you double check that part of the model? Because boy, what he's saying sure sounds right. And she said the 2 words I was hoping she wouldn't say, which is what? Uh-oh. She said, uh-oh. And it was like, okay, what does that mean? Oh, we have an error. It's like, oh, great. I just told the CEO we're absolutely sure there's no errors. So, but there's errors in all these models. It's just, part of the thing is to make your models so they're easy to audit. Don't make them, don't have a formula that's just so massive. Break up the formulas, put in comments so you know what you're doing, so you can find stuff as much as possible. So all your assumptions in one place, use a lot of comment boxes, document as you go, have other people double check it. I remember telling the CFO once, so they put me in this department, there was 3 of us, an SVP, an executive director, and me. I was the peon in the department. It looked really hilarious because the SVP had a secretary, so she was an executive secretary. So she had a massive desk. The SVP had a massive office. The executive director had a massive cubicle, and then you have my little cubicle sitting over there. But the SVP was a stock guy. The executive director was a real estate guy, and I was a kid who studied fixed income on the CFA exam. So I was the fixed income guy. And that was my entire training, was studying for the CFA exam. And so I'm running all these models. Remember, I'm the guy who got us to sell $15-20 billion worth of mortgage backs based on my models. So I mentioned to the CFO, I go, Joe, I just, we're about to sell $15 billion worth of securities based on a model I built, and no one has come to check my models to see if there's any flaws in it. I'm just mentioning that to you. I think he lost a little sleep the next few days on that, but I mean, it's pretty amazing, right? A company like USAA, here I am, I'm pretty green. Everything I know is textbooky, and they're going to make this massive decision based on something I built, and no one's checked it, no one double checked it. That's what I'll get back to. Don't assume firms are that sophisticated. It is pretty amazing. I made him nervous. He said, no, someone needs to get down to Ron's desk and look at the model. No one ever showed up, but at least he was worried about it. So have other people look at your model. The advantage I had at USAA, we had all these actuaries and we had PhDs in math. I had people there that really could have done some pretty good scrutiny of the model, but no one ever came by to look at it. The 2 people in the department, my boss and exec director, they had no background whatsoever in fixed income. So it wasn't, they wouldn't have been able to check it if they wanted to. They just didn't know that market. Then quickly admit when you made a mistake, set up. So don't do like I did and say, no, we're sure it's right. Don't ever do that. Just, say, yeah, we need to double check it. Let's make sure. If someone asks the questions like, wow, I don't really understand that, then, let's double check that. And so that's why I say this, I keep using this word. Where is it? Extreme. Run a really, really extreme scenario through your model and see if the output makes sense on the other side. You say, hey, let's have the stock market fall 80%. And you run the model, says, yeah, it doesn't really have much of an impact. It's like, what do you mean? That should have a pretty big impact on your firm. So there's something wrong. So go really extreme. What if oil prices go to 300? What if the 10-year treasury goes to 15%? Let's try it. Let's just try it and see. Take the 10-year to 15%. In your firm like USAA, that's 80-90% bonds. There should be an impact. If interest rates move that much, you should notice it pretty dramatically. So go to the extreme. The Signal and the Noise is a good book by Nate Silver. He talks a lot about modeling and what you can do. The other book I really do like. Just a more current one, that one. I know I've recommended this book before, but I do highly recommend this book here. Have any of y'all read this yet? Super Forecasting. Really good book. I think every finance major, probably every actuarial science major should read this book. And Tetlock, we're going to see his name again because Taleb talks about Tetlock in his book. But essentially what they do in this book is they have a website. You could probably go find their website where they just go out and ask people to do forecasts. So what's the probability China is going to attack Taiwan in the next 5 years? And you put that probability down. What's the chance a 16 seed team is going to beat a 1 seed team? You do that forecast. What would you have forecast on that? How many of y'all? So you probably got it right, Eric? You had that coming in. That was a pretty big upset. It's only happened twice. So I would have done better in mine if I just gone with the original seatings. I didn't do too well. But they have people forecast that. And then what they do is go and look at the forecasters that are the best, those that are consistently better than the others. And what this book is about is what is about those people. What's their personalities? What's their approach? What's their analysis? What is it about them that makes them superior to other forecasters? And I would recommend you read it so that you see if you have those characteristics, and if you don't, if you can incorporate them. And the obvious ones are like they doubt everything they believe. They have no confidence in predicting the future, which means they're very quick to change their opinion anytime new data comes in. Most people, the majority of people in the world, once they set a forecast, they invest their ego in it, and then they're looking for confirmation data. People that are good forecasters, they have no trouble throwing out a forecast. They have no trouble saying, I'm wrong, I'm going to switch my forecast. That's a hard characteristic to incorporate, but you can set it up, and we'll talk about it when we talk about Andy Duke. You can set it up by avoiding declarative statements to your boss. When your boss says, what do you think the Fed's going to do? You don't say, well, the Fed's obviously going to, you don't state it in obvious terms, state it in probabilistic terms. That's why Andy Duke says, speak in probabilistic terms. So don't tell your boss, the Fed's going to raise rates. No, I think there's a 60% chance they're going to raise rates, but there's a 20%, 25% chance they're going to cut rates because of this banking crisis or whatever. Set yourself up so you can get out on the other side so your ego is not involved. Once you invest your ego wants to be fed, and you will avoid any article that contradicts what you believe, and that's the last thing you want to do. So read this book. It's not a very long book. I don't know how many pages it is. I don't remember it being that lengthy of a book. Did you already see it? I can never see it. Yeah, it's a short book. You could read it in a week. Or a day even. It's not a very long book. And I got other books in here related to that. So there's the Naked Statistics. Have y'all done Naked Statistics? That's a great book. It's too late now, but I think every finance major should have to read this book before their first stats class, because they do a great job in this book of showing how stats is actually quite powerful and useful. Whereas a lot of students go to stats like, well, I'm glad I got out of that. I won't ever need that again. And then it's like the most important class you ever took in your entire career. There's a signal and a noise. All right. So I think I already mentioned this. All models are wrong. Some are useful. So get in the approach. We can't really model the world. We can kind of just approximate it. And then I love this quote. I can't remember where I heard it. It might have been at a conference. But models are not evidence. The fact that your model gives your distribution that's not evidence that that's what the distribution is. All right, so models are not evidence. It's not a sample size. Like, I looked at the last 50 years and I looked at 100 years from a model. That's not evidence. All right, here's a few quotes. Aristotle, y'all remember him. Aristotle, pretty impressive guy. I don't know if y'all seen some of the things he did, thousands of years ago that we still use today. His name comes up a lot. I think his name came up. Steve Hawking's book on time. I think he mentions Aristotle and some Aristotle's views on time. And I mean, it's pretty amazing. Smart guy. But he said a smart thing back then. It is the mark of an educated person to look for precision only as far as the nature of the subject allows. That's a great thing for any finance major to understand. Not quite as, Hubbard's not quite as efficient as Aristotle. Ineffective methods are used with great confidence, even though they add error to the evaluation. What is he talking about? So I'm going to step on toes. Y'all can handle it though. So you're going to see these things. There's a heat map. Have y'all heard of heat maps? Have any of y'all seen heat maps? Do y'all use them in college classes? In a college class or in a job? A what? Okay. Yeah, Hubbard thinks these things are worse than useless. These things they do more harm than do good. We use them at USAA. Have we talked about these yet? I can't remember. So you have a probability and you have an impact. So frequency and severity. You have to fill these out. So they say, okay, stock market crash. What's the probability of that happening? And how much would you lose if that happened? So you say, oh, probability of that, okay, down here. The problem is no one defines these things. Is rare 1%, 0.1%, 3%? What's rare? And what's high impact? Is that $1 billion? Is that $1,000? So is 1% a low probability or high probability? Is that rare, 1%? You're going to go skydiving this year. And there's a skydiving company, they do 10,000 a year and their error rate's 1%. They only lose 1% of their customers a year. Pretty low, rare event. Does that sound like a rare event? Would you go to a skydiver that has had 100 people die this last year? That sounds like a pretty high probability, doesn't it? Maybe it's because the impact is so massive, but 1% for skydiving is much higher than 1% for an auto accident. You know, so mainly because you can survive an auto accident. It's pretty rare for people to survive I guess people have. I've seen some pretty amazing stories, but that's the problem. But there is no probability given. When they gave me the heat map, they didn't say assume 1%, assume 0.1%. They just said rare. And then on the impact, they didn't say there may be some manager out there going, oh, $1,000, that's pretty extreme. And I'm thinking, you know, $1 billion. Well, yeah, that's kind of a difference. And all that information from all these different departments with no definition is then thrown together in one big chart. And they take it to management. And what does management do? They go, oh, yeah, look at that. And then what do they do? What do you do next? You focus on these events where they're pretty rare. I guess you shouldn't be doing that, right? That'd be pretty bad to be doing that. Something that happens all the time. When it happens, it destroys you. Yeah, let's stop doing this stuff. What's going to be in that column? You know, you'd hope there'd be nothing. You kind of have to ask about the manager that says, yeah, we had this stuff happens all the time, and boy, it kills us every time it happens. You have to say, well, why haven't you stopped it? It seems like that would be your job, right? But anyway, that's what they do. So I'll tell you the story with Sarbanes-Oxley. This came up. The audit team came in and they wrote me up on one thing using a heat map, and they were upset at me because Michael ran a report. He's the only one who knew how to run a report. And if he took vacation, we wouldn't have that report. And I said, well, we didn't have a report 2 years ago because Michael just created it. We somehow survived 2 years ago. But yeah, that's right. And that was right after I started doing derivatives at USAA. And I said, do you realize I can do in one phone call, I can bring this whole company down? I was just curious if you might want to add that to your list because you didn't pick up on that one. And then they got real worried. And it's like, yeah, you need to. There's bigger risk out there that you never asked us about, but you're worried about Michael taking vacation. He never took vacation anyway, so it was never a problem. In fact, one vacation, I come in on his vacation day and he had been there since 5 a.m. It's like, oh, I'm leaving. I see you get this thing out. It's like, yeah, you're supposed to be on vacation. But that's the heat map. I have people get really upset because they use heat maps at their company. USA uses them. Valero, I think, uses them. And they're very defensive of these things, but I'm just letting you know Hubbard doesn't like them. I won't tell you that I think they're useless. I'll hide that from you, but perhaps much effort is spent on seemingly sophisticated methods. And it does seem really sophisticated because you're collecting all this data and you put it in these spreadsheets, but there's still no objective measurable evidence. And this is the key for him. I'm going to have you watch some videos with Hubbard, and I think this is really key for him. Does the firm perform better having used heat maps? Do firms that use heat maps manage risk better than firms that don't? Is that a reasonable question to ask? We use this process, they don't use this process. We both have the same number of accidents. We both lose the same amount of money. So why are you doing this? But no one ever measures that. They just assume it's working. Why? Because they're doing it. And he's asking the question, and that's what he actually does in his job. He goes out and he measures these things. Do firms who do this do better than firms who don't do this? perfect question to ask. The sophisticated methods are far worse than doing nothing. Are they made, they're far worse than just wasting money on the effects. Why are they worse? They cause erroneous decisions to be taken. That you don't want, right? We have this heat map, and because of the heat map, we can now do X when they shouldn't be doing X. And not only are doing X, but they're doing X with great confidence because you just showed them a heat map. Note that in this spectrum, doing nothing about risk management is not actually the worst case. It is in the middle of the list. Those firms invoking infamous, at least we are doing something defense, are likely to fare worse. Doing nothing is not as bad as thing. The worst thing to do is adopt a soft scoring. This is exactly the heat map is what he's talking about. Now, don't say all of this your first week on the job, all right? Give yourself at least a month before you start stepping on toes. Our unproven but seemingly sophisticated method, crackpot rigor, and act on it with high confidence. So we'll see his video. He does a great job. He says there are methods that work. Not only do they work, but I can prove they work because we've done analysis of them. And I can prove that these processes don't work because the firms that do them are no better off than the firms that don't. So we'll see some more of Hubbard. So model risk. What is your firm actually spending time and money on? Now, when I started in finance at USAA, the risk management department was a guy named Jerry. I think I told you that before. Now it's 1,000 people. I have no clue what those 1,000 people are doing. I would love to know. There was one department, he had 70 people in his department doing this type of modeling. I don't know what those 70 people are doing 5 days a week. I really don't know. I mean, if you're running models, you would hope a decision's being made, wouldn't you? That someone's making a decision to do something. They're not just running models to run models. 70 people times 5 days times 40 hours, running models, and then what? So I don't know. I should have him come in and speak to y'all. It'd be interesting. Smart guy. I really enjoy working with him. I think he could tell I was somewhat, when he talked to me, I go, 70 people, did you like eliminate the departments and the subs and bring them all together? No, they still have their departments. He could tell I was like not quite getting it, but anyway. Not that one guy named Jerry was good, but 1,000 people named whatever. I don't know if that's all that much better. It's, this is CEO say I don't have anything to worry about. This is USA. Does USA have anything to worry about? Didn't they just pay a massive fine because their bank messed up pretty badly? So they probably should have brought Jerry back. He probably would have cut that, but somehow they missed all of that. All right, legal risk. Y'all interrupt me if I'm stepping on toes. I like stepping on toes. Don't step on my toes because I hurt my foot playing soccer, and Alex thinks I might have cracked my bone or something. So yeah, talk about risk management. Don't play soccer when you're 60 years old. It's just not healthy, especially when you're bad at soccer to begin with. All right, legal risk. So I was kind of in my P&C class asking them about the business law class. Y'all take business law now? And what are you studying business law? Because it sounds radically different than when I took it.
Yeah, I mean, it's a lot of like different modules kind of like over like structuring the businesses, and then we go into like.
Oh, so
like,
it's
yeah,
okay. So y'all didn't do the West Business Law book?
like,
Right. Yeah, it's the biggest book I had. It weighed about 40 pounds. You put it in your backpack and it was ridiculous, but we had to take 6 hours of this, and it was contract law. It was the UC, and y'all didn't study the UC, did y'all? Universal Code, extremely important. Tort, we had to study tort, we had to study agency. Have y'all doing agency law?
I think that a little bit. I know.
And agency law is pretty important, pretty critical. All right, well, you may want to go take a course on your own. I was shocked at USA. I needed a contract, and so I just assumed the lawyer would write it. So I go to a lawyer, and he says, "Yeah, write everything you need, and I'll add in the boilerplate." You want me to write a contract? Yeah, because I don't know what you need. Just write what you need. like, okay, I'm writing contracts, and I'm sure glad I had good business law professors to write contracts, understand the components. I mean, y'all at least did that right, consideration and meeting of the minds. Y'all did that stuff, right? What's a valid contract? So at least you know that space. So contracts are important because contracts define who gets the risk when it happens. Contracts are extremely important to risk management. The only time I've ever sued anyone was I sued my apartment, and I won because they didn't show up, but I think I still would have won. But their contract was ridiculous. So I rewrote the whole thing and mailed it to them. They didn't accept it. So I left the apartment. It was just a ridiculous contract, but their contract was shifting tremendous amount of risk onto me that I didn't want. I mean, if my neighbor burned down the entire complex, I had to pay for any damage they did to my apartment. Like, no, you can go sue them. You're not gonna have me pay for the windows they broke. You know, I don't want that risk. And my homeowners doesn't cover that, you know, well, maybe the liability part of it was. So I read that, and that's a big part of what that contract was doing, was shifting risk to me. And I'm not doing that. I can go buy my own house and take that risk on myself. So contract risk is, you think you're covered in the contract and it gets reinterpreted in some way, or you didn't shift a risk. But contracts are all about, and so you might want to change your perspective on contracts and think of them as a risk management tool. The purpose of this contract is to decide what happens when things go wrong. I think I showed y'all the swap contract earlier, right? And we talked about that. Yes, complicated things. How do you measure it? I don't know. Maybe the number of pages, how complex the word language is. I showed you that swap contract. There were sentences that I could read 20 times, and I was like, I'm not real exactly sure what they're saying here. It can be a real pain, and your lawyers may not know either. The lawyers I dealt with had never done a swap contract. They never heard of it. They didn't know what they were. So it was out of their league. It's pretty tough. And sometimes in finance, we do stuff no one else has ever seen before, and you're gonna have to go find someone to help you out. How do you mitigate it? Careful use of language. So the way I did it with the swap, I mentioned this early in the semester, is I just went through scenarios. Okay, I don't know what this language is saying, but let's say this happens. Can I do this? And I need someone to sign off and say, yes, I'm sure you can do that. And say, okay, that makes me feel better. You should never trust lawyers because they're very busy people. And their goal is not to answer your question. Their goal is to get you out of their office. So if you ask a lawyer, can we do this? What are they going to say? No, we really can't do that. So you go to the lawyer and say, we need to do this. I need you to help me figure out how we're going to do this. Do you have an experience in this area? No. Well, can we find some lawyers that do have experience in this? You know, you go in saying, you're going to do something for me. It's going to be complicated. Let's go for it. You know, so my lawyers used to hate it when I show up, but I needed their help. We needed that language written. You know, the swap contract, you think about a swap contract. So you got the company, that's you, UTSA. All right, that's fine. I've got the bank, the broker, the one setting up the swap. That's the agent bank. I got my record keeper. That was oh, I can't remember who that was. Maybe State Street. I got the custodian. That was, I can't remember, Bankers Trust, maybe. I can't remember. It's been too long. All four of these entities have to review and sign the contract. All four of them have to be on there. So you get the contract that's almost there, you're almost done. Someone changes one word. You now have to go back to all four, get them to sign up. You go back to State Street, it's like, yeah, Mary's on vacation for the next 2 weeks. Okay, well, I need it now. So it's tough. You gotta really set it up. And that's why I say, and I think we talked about this before, get the infrastructure set up well before you need it. I can't even spell infrastructure. It makes me so nervous. Infrastructure doesn't have a W in it, does it? Infrastructure. Still not right. Come on, Bill Gates, help me out here. What am I missing? Oh, structure, okay. So if you want to do swaps, they'll say, hey, when we want to do swaps, we'll get the contracts. No, if you think you might do swaps in the next 5 years, do it, get them set up today. If you think you're going to do options, I discovered on options, it was pretty amazing. My option trader, I thought it was going to be pretty straightforward because we had our option trader, we had a pretty good contract in place. And then our custodial bank completely messed up and we had to unwind the whole thing really fast. It was just an absolute mess, so frustrating. And what was irritating to me is the person I was dealing with at the custodial bank, I kept asking him, can y'all do this? Oh yeah, we do that all the time. Piece of cake, don't worry, we'll have it done in a couple of days. That's the sales rep. The back office, no one ever talked to them. He never talked to the back office. And so when we did our first transaction, back office like, we can't do this. Like, I thought you did this all the time. Oh, they said they've never done the spread. They've done the other. I said, but I told you we're doing spreads. Like, yeah, they can't do that. It's like, so we had to shut the whole thing down. So set up before you need it and then test it. Actually do a transaction. Make sure it actually works. That would have helped me a lot in this one transaction. My first transaction was a full-blown live transaction and the whole thing just blew up. So frustrating. And ended up not losing us anything, but it would have been pretty bad if the market had blown up right after that. And my boss was like, well, I'm so glad y'all did those hedges. Like, well, we had a little problem with the custodian bank, so we didn't do anything. So yeah, we lost a lot of money. Sorry about that. Next time we'll do better. That doesn't work really well in finance bosses. So you just got to spend some time, get to your lawyers early, be really nice to your lawyers. I had a good lawyer, a guy named Dewey. So that was funny. You know, have y'all heard of the law firm Dewey, Cheatham and Howe, right? So he was the Dewey of Dewey, Cheatham and Howe. Really good lawyer, but he was an ERISA lawyer. So he knew about benefit plans and that kind of thing, but he didn't understand, you know, as smart as he was, he didn't have this other stuff. So doing a swap contract and a pension plan, that wasn't something he knew much about. So start early. Test things, do your own research, whatever it takes. Maybe I should say here, don't trust sales reps. I should have put that in there. Wow, my computer likes that too. So yeah, sales reps will tell you whatever they have to tell you to get the contracts. So if a sales rep says, yes, we can do it, you might say, let me talk to the back office. The back office will tell you in a nanosecond whether they can do it or not, because they know. They do this stuff every day. He could have called, I don't know why he never called the back office. He could have called the back office and answered my question the same day I asked it. He just kept telling me, oh, we do that stuff. He just assumed his bank did that all the time. And they didn't. And so it was very, very, very frustrating. This is maybe the more negative side of the job, because this is just kind of like you just got to get it in place so you can do stuff. One thing we tried with the swaps is we wanted to have 10 swap contracts set up with 10 different entities. We only got 2 done because it just burdensome. But you know, it's tough. It was funny. Barclays said, come deal with us. We'll have your contract done in a week. And 6 months later, my lawyer said, we can't deal with them anymore. They're impossible to deal with. It's just, you know, sales reps will tell you whatever they need to tell you. All right. So there's the lawyers. What about those accountants? So we'll talk about the accountants. Any accountants in here? So we'll talk about the accountants next time. You got to be really nice to the accountants because you're not going anywhere without them. So we'll talk about how to handle the accountants